learners. I hope we are all okay. I'm your instructor, 𝐶PA 𝐿𝐍, and in our session today, I want us to talk about taxation, majorly basic concepts. I've received a lot of requests from you, my good students, in relation to some basic concepts of taxation. Majority of the students, they normally tend to fail tax, not because that they don't know tax, but you'll find that you can't handle tax, you can't pass tax if you're not good on some basic concepts. Majorly, we normally tend to talk of 5 main things that you need to know when it comes to taxation. And by the way, it is not only for exams purposes. This knowledge is the same knowledge that we normally tend to apply it practically. So you'll find that once you are able to have this knowledge in tax, trust me, you can't fail tax. But if you're doing intermediate level, if you're doing advanced level, that is for custom courses, or any course that you're doing for tax, regardless if it is NEC course, regardless of the course that you're doing for tax, and it is within the jurisdiction of Kenya, you'll find that it will always be very, very easy on your end. So I want us to categorize these areas into the following categories, and we'll be looking at each one of them one by one, so that this aspect of us maybe not performing well in tax, it should cease and cease completely, courtesy of this video. I've also realized that majority of the students probably, I don't know where they are studying, but they are still using the previous race, which is very, very, very wrong. As of now, I'll also encourage you lecturers, probably also, I know you normally also watch my videos, so that you can also, when you are training your students, kindly try to make sure that you've updated the notes that you normally tend to train your students with. Because these little elements can be very catastrophic when it comes to their exams. So also for you lecturers, just a word of advice, also kindly also make sure that you are guiding your students with the updated notes. So looking at the basic concepts of tax, we normally categorize them into the following, which will be dealing with them one by one. Number one, you can't do tax if you are not good, and this is the main thing. If you're not good in the following, that is number one, talk of taxable income, non-taxable income, and the aspect of allowable expenses and non-allowable expenses This is the foundation of tax. This is the backbone of tax. You can't handle tax, or you can't handle tax practically, or even pass your tax exams if you're not good in this concept. I'll be sharing the notes on the same, or you can just below this video, I'm going to attach the link where you can get these notes. They're very, very efficient, and they really, really assist you to handle tax very effectively. Number two, we are having concept known as taxation of other sources of income. Taxation of other sources of income. Taxation of other sources of income. Taxation of other sources of income, ideally, we are talking of interest and dividends income. Interest and dividends income. This is also very vital, because you'll find that in each and every problem that you'll be handling, more so when the examiner wants you to compute the taxable income, this will be very vital. This will be very vital for you to understand that. Number three, you must be very good in understanding the approaches of determining, talk of approaches of determining, or computing taxable income, approaches of determining or computing taxable income. This is so very vital. More so, this is now specifically for exams purposes, because once you're told to maybe determine, say, adjusted taxable income, and you end up using the gross profit approach, you'll start failing from the word go. Even the marks that you normally term them as entry marks, there's a very high chance that you're going to lose these marks. So it is very vital that, again, we do understand when am I supposed to use which approach, and at what point am I supposed to use what? This approach. Then talk of number 4, key element that, again, you must always be very, very good at. Basically, these are what? Capital investments deductions. Capital investments deductions. It is very unfortunate that up to date, 2022 July, there are some students who still use the previous rates of capital investment deductions, which is very, very unfortunate. So guys, I'll want you to do whatever that you can to make sure that you are updated on the aspect of capital investment deductions. Very, very key. Then the moment you have understood that, number 5 key element that, again, you must be very good at, commonly examinable, practical knowledge is very vital. This is a concept to do with what? VAT. 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 Basically, these are the main foundations of tax. You can't handle tax comfortably if you don't have this knowledge. If you don't have the concepts from 1 to 5, and this applies to students who are doing intermediate level to students who are doing advanced level. You can't handle tax comfortably if you don't have this knowledge. That one I can tell you for a fact. And probably right now, because you are preparing for your exams, yes, you might say that time is very limited for me to do everything in tax. The best advice that I can give you, if you're doing taxation, 𝐂𝐎𝐍 exams probably this August, or any other taxation within jurisdiction of Kenya, I normally have students from 𝐂𝐻ESTRA engaging with them in some various areas. We normally tend to have our students doing NEC, that is aspect of taxation. So long as you're doing tax, in whichever course that you're doing, make sure that you have basic understanding of what Mwalimu has stated here. It will be very, very important. It will be very, very important on our side. So, for 𝐂𝐎SNEB students who are doing the exams this coming, or rather maybe next month, or rather I can say very soon, make sure that you've taken an advantage of what we are giving you guys. Currently, we're having a very special offer for your revisions. Maybe for those who feel that time is very limited, we have a very special offer for your revisions, which you can take an advantage of, and at that point, you'll find that you'll be increasing your chances of passing tax on a first attempt very, very effectively. So take an advantage of that. You can always, of course, reach us on the number below the screen, and you can always guide you more on how you can get more videos, more revision videos, more classwork videos. It will be very, very important for you guys. So, mentioning that, today I want us to handle the second part. I'm going to share the notes and of the first part, which below this video you're going to get a link. If you click that link, definitely will take you to these notes, which you can download and study them at your own pace, so that to make sure that you have understood this concept clearly. So, looking at taxation of further sources of income, which is very vital, talk of taxation of other sources of income. That is what we are looking at. Taxation of other sources of income. Taxation of other sources of income. Taxation of other sources of income. So, at this point, you say that our focus will be on two main elements. These are, number one, we've talked of the aspect of dividends income. We've talked of dividends income. And we've also talked of what? Interest income. Number two, we've talked of interest income. Interest income. So these are the main taxation of other sources of income that we normally tend to talk about. And that's why I'm saying it's important, because if you take your paper for tax right now you must find where you're having a certain dividends. Maybe they received dividends from us, whichever source that you were given. They received interest from whichever source that you are given. So it would be very vital for us to understand these elements. Therefore, we start with the first one, dividends income. I want us to start with the first one, which in this case we are talking of dividends income. Talk of dividends income. Talk of dividends income. So, for tax purposes, my good students will find that this income is categorized into three. This income is categorized into three. Number A, we normally tend to talk of exempt or non-taxable dividends income. Number two, we normally tend to talk of qualifying dividends income. Then we normally tend to talk of number C, non-qualifying dividends income. Non-qualifying dividends income. So basically, these are the three categories of dividends that you normally tend to talk about. That is, of course, qualifying, non-qualifying, and exempt. So therefore, let us dissect each one of them so that we should be having a clear knowledge and understanding of each and every component here. So in that case, I'll want us to start with the first one, which in this case is exempt. So talk of exempt. Or in this case, we've said it is also referred to as non-taxable dividends income. Non-taxable dividends income. Let us start with this and see what it entails. So, my good students, anytime we are talking of non-taxable income, just as the word suggests, these are dividends that will not be subjected to any form of tax. That is what you should understand. That these are dividends that will not be subjected to any form of tax. That's why we are terming them as non-taxable. So the most important element to understand here is the types or talk of types of such dividends. Talk of types of these dividends that you are talking about. So number one key element, anytime you are talking of the non-taxable dividends, or rather exempt dividends, will include the following. Number one, we normally tend to talk of dividends received from investments, outside Kenya. So number one, we are talking of dividends received, dividends received from investments, outside Kenya. Dividends received from investments outside Kenya. Basically, we are talking of what? Foreign dividends income. Foreign dividends income. Dividends received from investment outside Kenya. In this case, we are talking of what? Foreign dividends income. If at all you come across dividends received from outside Kenya, always know that that should be taken as what? Non-taxable dividends. Number two key element to understand is dividends received by an insurance company. Number two, talk of dividends received by an insurance company. Dividends received by an insurance company. From its life assurance fund. From its life assurance fund. Or simply, we normally tend to talk of dividends received from a life insurance fund. That is very important for us to always have at the back of our mind. Talk of number, the other number here, we normally tend to talk of dividends received by a resident company. Number three, dividends received by a resident company, dividends received by a resident company, dividends received by a resident company, where it controls 12.5% and more, where it controls 12%, 12.5, where it controls 12.5% or more of the shareholding of the company, of the shareholding of the company, of the shareholding of the company. So whenever we have such dividends, at the back of your mind, always know that we are dealing with non-qualifying dividends. We are dealing with non-qualifying dividends. You are dealing with non-qualifying dividends. That is very important to note, which in that case, we are going to take that as our number A. Talk about number B, qualifying dividends. Qualifying dividends. Qualifying dividends. Very key to understand qualifying dividends. When we are talking of qualifying dividends, my good students, basically, first of all, what does qualifying stands for? What does qualifying means? At this point, we'll just be looking at dividends that at this point, you'll find that they are subjected to withholding tax at the rate of 5%. And this withholding tax is a final tax. Mwalimu is repeating again here. We are saying that anytime we are talking of qualifying dividends, you are looking at dividends which are subjected to withholding tax at the rate of 5%, which is a final tax. I'm really insisting on a final tax. So this is what you are saying, that basically these are dividends which are subjected, dividends which are subjected at withholding tax at a rate of 5%, which is a final tax. Actually, I'm going to have this with another pen so that should sink very well at the back of our mind, which is a final tax, which is a final tax, and I'm having it with a capital letter to insist that concept, which is a final tax, I know you'll wonder, Mwalimu, what is this final tax? So key elements you're talking of, 5% withholding tax and is a final tax. Anytime you are talking of an item being a final tax, that is to say, that is the only component of tax subjected to that income. It will not be taxed anywhere else. That will be the only, I repeat, that will be the only component of tax subjected to that income. That will be the only component of tax subjected to that income. That's why you're talking of what? Final tax. That's why you're talking of final tax. Key element will be, what are the examples of this type of dividends? We can note and say that this includes dividends paid by, 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 number one, we should understand, talk of public limited companies. Number two, talk of private limited companies. Talk of number three, 𝐊𝐶𝐶os, dividends paid by 𝐂𝐬𝐶𝐂𝐬s, dividends paid by 𝐂𝐬𝐶𝐂𝐬s, dividends paid by 𝐂𝐬𝐶𝐂𝐬s. So at any given point, whenever you've come across dividends that are paid by the following parties, that is limited companies, public, private limited companies, as well as 𝐂𝐬𝐶𝐂𝐬s, these dividends will basically attract a component of tax which is 5%, and that will be the only component of tax, withholding tax. Recall the concept of withholding tax. Tax charged at source. Tax charged at source. So basically, this is what we should always tend to have at the back of our mind. So that is qualifying dividends. Finally, on this, we should be looking at non-qualifying dividends. Non-qualifying dividends. Non-qualifying dividends. Non-qualifying dividends, which should also be very, very key to understand. Non-qualifying dividends. Non-qualifying dividends. So when we are talking of non-qualifying dividends, my good students, what should come at the back of our mind? Whenever we are talking of non-qualifying dividends, what should come at the back of our mind? So simply, at this point, whatever that we are looking at the aspect of dividends that are subjected to withholding tax at the rate of 15%, which is not a final tax. We are saying that dividends which are subjected, dividends which are subjected to withholding tax, at a rate of 15% and is not a final tax, which is not a final tax, I'm going to underline these keywords. First of all, withholding tax is 15%. And again, they are not a final tax. I want you to get that difference between final and not final tax. I want to get the difference between final and not final tax. Anytime you are talking of not final tax, this is to say that these incomes, they are going to be aggregated with other incomes and taxed further. So we are saying that these dividends are going to be aggregated. They are going to be aggregated with other incomes and taxed further. They are going to be aggregated with other incomes and taxed further. So if at all I'll be having my other incomes, which will include, say, for example, rental income, farming income, and any other form of incomes. So I'll be having my business income from my main operations. Then in addition to these incomes, we are going to add the non-qualifying dividends, which is going to be taxed further. It will be very clear when you'll be looking at all the format of presentations, which we are going to look at in this series of ours to understand the basic concepts of tax. So therefore, we are saying that qualifying is a final tax. That is the only component of tax. Non-qualifying, withholding tax is 15%, yes, but this income is going to be aggregated with other incomes and taxed further at a rate of 30%, which is corporation tax for resident, and 37.5%, which is corporation tax for non-resident companies, where we'll also be looking at a case. I'll also be required to give the relief as at the end of the day before we determine the net tax payable. So, key element that we should summarize with this concept is to understand what are these types of dividends that we normally tend to talk about here. So in this case, we can note and say that These are dividends paid out by, these are dividends, talk of these are dividends paid out by cooperative societies, paid out by cooperative societies, paid out by cooperative societies, paid out by cooperative societies. That is very key for us to understand. That is very, very key for us to understand. So basically, this is what will entail the aspect of dividends. This is what will entail the components to do with dividends. And it will be very important that you master each and every concept, because you'll find that, as I've said, in each and every course that you'll be doing, should it be intermediate, should it be advanced, or whichever course that you're doing, so long as it's in the jurisdiction of Kenya and it's tax, you'll always find that this concept will always be very, very important and very, very ideal for us. At that point, if you're having any question and you need any clarification, of course you can engage us just on the comment below, or you can take your phone, call us on the number indicated there, and we'll always be there to assist you guys. So this is the first case. We've looked at what? Dividends income. Let us jump to the second component of income, which is vital for us to understand, and that is what? That is aspect to do with interest income. So allow mwalimu to erase here. Allow mwalimu to erase the components of dividends, which you are done with that. And I'm hoping that you've been able to understand that concept clearly. So we are done with dividends. Let us jump to interest and see what interest income entails. So therefore, number B, we are talking of interest income. Interest income. So again, you'll find that for tax purposes, interest income will be categorized into three. The same case as we had looked at, number one, the same case as we had looked at with the aspect of dividends, I'll be having exempt, or in this case, term it as what? Non-taxable interest income. Number two, we will be talking of qualifying interest income, qualifying interest income. Number three, we will be talking of non-qualifying interest income. Non-qualifying interest income. Non-qualifying interest income. So basically, these are the types of interest incomes that we'll always be talking about. So therefore, we dissect the first one. We start with number one, or A, term it in this case. You are looking at what? Exempt. Talk of exempt or non-taxable. Non-taxable. Non-taxable interest income. Non-taxable interest income. Non-taxable interest income. What are these interests? What are these interests? So anytime you are talking of non-taxable income, my good students, simply we are looking at interest that will not be subjected to any form of tax. That's why we are saying that they are not taxable. Interests that will not be subjected to any form of tax are what we are referring to as non-taxable incomes. So what do they include? Number one, we should be talking of interest income received from foreign investment, just like dividends. So we'll be talking of course, interest income received from foreign investments. Sort of interest income. Interest income received from foreign investments, from foreign investments, from foreign investments, from foreign investments. That is on number one. Number two, my good students, what we should be able to understand when it comes to interest, we normally tend to talk of what? Interest from post office savings bank, interest from post office savings bank, from post office savings bank, from post office savings bank, which is very key that you should understand. I don't know why you normally don't kind of deposit your cash in post office savings bank. Yeah, nowadays we are on commercial banks, right? So interest from post office savings bank, that one is also an exempt interest. Talk about the aspect of number three. We normally tend to talk of course, interest on East Africa High Commission, interest on East Africa, interest on East Africa, interest on East African High Commission, East Africa High Commission. But this is in the case of non-resident only. Talk of in the case of non-resident. In the case of non-residents. In the case of non-residents. And I believe when Mwalimu is talking about residents and non-residents, I'm very sure it's not a new term for us. It's very familiar, right? Which at this point you should be able to give the elements that should certify for you to be termed as a resident, both individual and a company. That one is also very vital. Talk about number four, interest, that we should always be having at the back of our mind here. We normally tend to talk of interest on deposit, interest on deposits, interest on deposits, interest on deposits, interest on deposits on home ownership savings plan, on home ownership savings plan, HOSP, limited to, currently we are talking of 96,000 shillings, limited to 96,000 shillings, meaning that excess of that will not be taken as what? Exempt interest. Then talk of number five here, we are talking of course of interest on housing development bonds, interest, talk of interest on housing development bonds, interest on housing development, interest on housing development bonds, interest on housing development bonds, interest on housing development bonds, subject to a limit of 300,000. Subject to a limit of 300,000. Subject to a limit. Subject to a limit of 300,000. Subject to a limit of 300,000. Subject to a limit of 300,000. And finally, number six, we normally tend to talk of interest. We normally tend to talk of course, interest arising from a registered retirement fund. Interest arising from a registered, interest arising from a registered retirement fund. Retirement fund. So if at all we come across these interest incomes, what should always click at the back of your mind is that we are dealing with what? We are dealing with exempt interest. We are dealing with exempt interest. Interest that will not be subjected to any form of tax. Interest that will not be subjected to any form of tax. So that's it with exempt interest. Talk about number B. We should be talking of the qualifying interest income. 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 And this is where I want you guys to be very, very tentative. This is where I want you guys to be very, very tentative, because I know this area normally tends to challenge a lot of students, but I believe at the end of this session, you will never be challenged again. You'll never be challenged again. So looking at qualifying interest, basically, what should come at the back of our mind, my good students? We are talking of qualifying interest as interests. Talk about interest received by individuals. Interest received by individuals. That is very key to note. Interest received by individuals. Interest received. Interests received by individuals. Interest received by individuals from financial institutions. From financial institutions. Interest received by individuals from financial institutions. And I'm really insisting, we are talking of what? Financial institutions. Let me underline these words. Interest received by individuals. It should be individuals. You see? Individuals from financial institutions. From financial institutions. E.g. of such you're talking of, for example here, we can talk of e.g. from banks, maybe insurance, talk about the aspect of government, that is treasury, bills, and bonds, etc, etc. So key word here is that if at all you are having interest and you're not dealing with an individual, if at all you're having a question, if at all you're having a problem which you're solving, and this question does not involve individuals, forget about qualifying interest. If you're having a question and you're given an interest, and that question is not dealing with an individual, forget completely about what? About qualifying interest. Forget about qualifying interest if that question is not dealing with an individual. So that's why Mwalimu is really insisting that we're talking about interest received by individuals from financial institutions. Example, you're talking of banks, insurance, treasury bills and bonds, etc, etc. And another key element, you're saying that these interests are subjected, these interests are subjected, these interests are subjected at withholding tax. These interests are subjected or rather they're subjected on at withholding tax at the rate of 15%, which is a final tax, So we should understand that these interests are subjected to withholding tax. These interests are subjected to withholding tax at the rate of 15%, which is a final tax. So keyword here, final tax. And we are talking of what? Withholding tax at the rate of what? 15%. So these interests are subjected to withholding tax at the rate of 15%, which is a final tax. And recall the concept of final, where we say that it will be the only component of tax. Once you are done with that, my good students, you can look at the final component here, which in this case we normally term it as what? Non-qualifying interests. Non-qualifying interest income. Non-qualifying interest income. Okay. So once we have this, basically, what should you understand? we normally tend to say that these interests are subjected to withholding tax. These are interests subjected. These are interests. These are interests subjected. These are interests subjected to withholding tax, at the rate of 15%, which is not a final tax. I'm really insisting, which is not a final tax. So we are saying, yes, withholding tax at the rate of 15% and is not a final tax, which is not a final tax. So therefore we are saying that these interests are going to be aggregated with other incomes. These interests are aggregated. These interests are aggregated with other incomes, and taxed further, That is to say, in addition to the income that you're going to generate as our business, I'm also going to add this interest that we received as non-qualifying interest, and therefore we're going to tax them further. Of course, at the corporation tax rate of 30% for resident and 37.5% for non-residents. That will be very key, my good students, for us to understand. After that, it should be very vital for us to understand the types of interest that we're talking about here. So these interests are received from, or rather these interests include, these interests include, talk of, I don't know if this space will fit. So basically this interest includes, number one, I've just erased that to make space here. These interests include, number one, talk of interest received from, talk about interest is received from companies. I'll just be very specific. Interests received from companies. Interest received from companies. That is, of course, it can be received from companies to other companies, right? Received from companies to other companies, okay? Number two here, we are talking of interest received by individuals and not from financial institutions. Interest received by individuals and not from financial institutions. Interest received by individuals and not from financial institutions. Interest received by individuals and not from financial institutions, right? Then finally, we can talk of interest received from housing development bonds. Interest received from housing development bonds in excess of 300,000. So basically that will bring us to the end of a very important and key concept that for you to pass tax, you must be very good at. The aspect of taxation of other sources of income. This was our lesson number 1 on the basic concepts of tax. Lesson number 2 on the basic concepts of tax, we are going to look at the aspect of format or approaches of computing or determining our taxable income. That will be our lesson number 2. This series is basically to give us the basic concepts that you must always tend to have for us to pass tax on first attempt in whichever course that you're doing, so long as it is within the jurisdiction of Kenya. So to this point, guys, thank you so much, and let us meet in the next session, the second lesson where we are going to look at what? The format or approaches of determining our taxable income and the best time to use such approaches. So to this point, thank you so much, guys.